Did you know that if you had invested just $100 in Amazon stocks in 1997, it would be worth over $1 million today? That's the power of smart investing. Investing is not just about stashing away your hard-earned money in a bank. It's about growing it, multiplying it, and making it work for you. Over time, smart investments can result in significant financial growth, helping you achieve your financial goals and maybe even your dreams. But how do you get started? Well, that's what we're here for. This video will guide you through the basics of 4 popular investment options: stocks, ETFs, bonds, and GICs. Each has its own benefits, risks, and considerations, and understanding these can help you make a savvy choice. So let's unravel the mystery of these investment options and help you make an informed decision. Think of stocks like buying a piece of a company, and ETFs as a collection of stocks like a mixed fruit basket. Let's delve into the exciting world of stocks and ETFs to understand the differences and nuances. When you purchase stocks, you're essentially buying a small piece of a company. It's like owning a slice of a pie. Your profits or losses hinge on the performance of this one company. The upside is that if the company does well, your profits can be significant. However, the risk is also high, as a downturn in the company's fortunes can lead to losses. On the other hand, exchange-traded funds or ETFs are like a mixed fruit basket. They bundle together stocks from multiple companies. It's like owning a little bit of a lot of pies. This diversification reduces risk as you're not reliant on one single company. If one stock in the ETF underperforms, it can be balanced out by others that do well. Now, both stocks and ETFs can be traded on an exchange, much like buying or selling goods in a market. However, stocks have a trading advantage as they can be bought or sold throughout the trading day at fluctuating prices. ETFs, although tradable, are priced at the end of the trading day, which means you have less control over the price you buy or sell at. In terms of potential returns, stocks can provide higher profits if you pick the right company at the right time. But remember, with high rewards comes high risk. ETFs, by contrast, offer more consistent, albeit often lower returns due to their diversified nature. Fees are another aspect to consider. While buying individual stocks usually entails broker commissions, ETFs may come with management fees as they are managed by a fund company. So where can you invest in stocks or ETFs? Well, you can purchase both through brokerages, online platforms, or even some banks. While stocks offer ownership in a company, ETFs offer exposure to a range of companies, spreading the risk. In the end, it all boils down to your risk tolerance, financial goals, and investment strategy. So, are you a single pie slice kind of investor, or is a mixed fruit basket more your style? Imagine lending your money to a friend in return for interest. That's how bonds work. Now imagine putting your money in a locked box and getting more money back after some time. That's a GIC. Let's delve deeper. Bonds are essentially loans you provide to an entity, be it a corporation or government. In return for lending your money, you receive periodic interest payments until the bond's maturity date, when you get your initial investment back. Bonds are considered safe, especially those issued by stable governments. However, the return rates are generally lower compared to riskier investments like stocks. On the other hand, a guaranteed investment certificate, or GIC, is an agreement with a financial institution. You agree to lend them a certain amount of money for a specified period, and they guarantee you a return on your investment. The beauty of GICs lies in their name, guaranteed. No matter how the market is performing, you'll receive your initial investment plus the agreed-upon interest at the end of the term. But what about risk factors? With bonds, there's a risk of default. If the entity to which you lent money goes bankrupt, you may lose your investment. However, this risk is relatively low for government bonds. With GICs, the risk is almost non-existent, as your return is guaranteed, but they lack liquidity because you can't access your money until the end of the term without paying a penalty. As for fees, bonds may come with brokerage fees, while GICs are typically fee-free. In terms of where to invest, bonds can be purchased through a broker or an online trading platform, while GICs are offered by banks and credit unions. To wrap it up, bonds and GICs are both secure investment options, each with its own pros and cons. Bonds provide better liquidity, allowing you to access your investment if needed. GICs, on the other hand, offer guaranteed returns, ensuring your investment grows regardless of market conditions. Bonds and GICs are generally safe bets, with bonds offering better liquidity and GICs offering guaranteed returns. Now that we've covered the basics, let's bust some common myths and discuss practices to avoid when investing. First off, let's address the notion that investing is akin to gambling. This couldn't be further from the truth. Investing is about making informed decisions based on research, while gambling relies purely on chance. Another misconception is that you need a lot of money to start investing. The reality is that even small amounts can grow significantly over time. Now let's talk about practices to avoid. Falling prey to herd mentality is a common pitfall. Just because everyone else is investing in something doesn't mean it's right for you. Diversifying your portfolio is also essential. Don't put all your eggs in one basket. Lastly, never invest without doing your research. Understand the risks and rewards before you put your money on the line. Remember, informed investing is smart investing. Before we wrap up, here are some bonus tips for your investment journey. First, remember the power of compound interest. The earlier you start investing, the more time your money has to grow. So start as soon as you can. Secondly, consistency is key. Make investing a regular habit, not just a one-time thing. Whether it's monthly, quarterly, or annually, find a schedule that works for you and stick to it. Another important tip is to review your investments periodically. Don't just set it and forget it. Markets change, and so do your financial goals. Regular reviews help you stay on track and make necessary adjustments. Lastly, never put all your eggs in one basket. Diversification is your best defense against market volatility. Spread your investments across different asset classes to reduce risk and enhance potential returns. Whether you choose stocks, ETFs, bonds, or GICs, remember that every investment comes with its own set of risks and rewards. So do your homework, stay informed, and make your money work for you. Happy investing!